Hello everyone. Welcome. This is JJ from Shadowing the Big Boys. Welcome to the first webinar that I have on the YouTube. Okay, so without further ado, what I will be sharing today will be on top 5 simple price action secrets for all beginning traders that you should know. Okay, so before we move forward, I would like to have this disclaimer, the same thing, where I'm not a professional financial advisor. If you need any financial services or advice, you should go to the professional financial advisor for advice. And that is so much. So all these things that are covered over here are intended for reference and educational purposes only. Okay, so the first price action that you should know is on mean reversion application. So you understand that the price actually will come to a mean average value once it pulls away too far from the average. So I do have some examples to show you all in the following slide. So let's move on to the first one. So this slide is actually showing a 200 EMA. So you see that the price actually came up and then pull back to the 200 EMA and then go up and come back down again. So what actually happens here is that in the box that are squared in green, those are the one that has put significantly away from the 200 EMA on this particular time frame of 15 minutes. So what we do over here is that we are looking for reversal pattern or reversal candlestick, whichever method that you are trading, to trade the market back to the 200 EMA. So these are the one that I have identified in green. Okay, and then the red one are the one that you should avoid, because those are the one that didn't pull too far away from the 200 EMA. Okay, so as a rule of thumb, I would like to actually advise to say that let's say for example, at least we should see a decent pull away from the 200 EMA, which is about 0.4 to 0.5% move. Okay, so this one you can actually see it quite easily by using the trading view function. There's a tool where you can actually drag and pull the price so that you can see how much it has already moved. So let's put a rule of thumb of about 0.4 to 0.5%. That will be a decent move away from the 200 EMA. Okay, all right. So yes, let's assume that we have a price that is moving away from the 200 EMA, and this is the around 0.7% that has been moved away from the 200 EMA. So subsequently, I do have other example as well. So this circle in green are the one that has moved away more than about 0.4 to 0.5%, and then we are looking for reversal pattern or reversal candlestick so that we can trade accordingly to the 200 EMA. Alright, so again the same thing, those in red are the one that you should avoid because the move is not significant enough. Okay, so much about the moving away from the average, or we call it mean reversion, reverting property of the forex market. So the second must know that you have should be the price action around a trend line, so we can make use of trend line to identify how we can enter the market using price action. Okay, so purpose one, of course, the trend line, you can use it as a trend following trade tool. So what actually happens here is that we understand that for trend line, for it to be valid, it should at least have more than 2 touch points. So over here you have 1 touch point, 2 touch point, and the third one you can actually look for a long position over here, and then after which there's also another touch point which we can also re-enter on the retracement to write according to the trend. So maybe this one in the middle doesn't really apply, so yeah, we will give it a miss. So the second purpose we do have is on the breaking of the trend line. We can also make use of the breaking of trend line to trade the market. So depending on what is your aggressiveness as a trader, you can use the trend line on on for different purposes. Okay, so this is the trendline break strategy that you can use. Then the third one I would like to go through is actually on the trendline break and retest, which is a method that I would prefer because it gives you more confirmation. Because once the trendline break, it can be a fake break, it can be going for a short run and then it bounce back up all the way. So sometimes that happens, but if let's say it breaks and that breaks a valid trend line, like for example this, and then it retests, and then maybe it form a valid chart pattern or some reversal pattern or continuation pattern like this, like it's a small consolidation before it breaks and continue further down. So those are the three purposes that I wanted to share with you all in terms of using of a trend line. Okay, so this is the trend line retesting. So the third one that I wanted to mention is a fake out movement at levels. So this level can be support resistance level, it can be a zone, it can be also a supply and demand area that you are looking at. So it does vary. Okay, so the first example, of course, we do have a resistance zone around here in the red band. So we see that the price actually came all the way up after a few days of retracing downwards, and we are seeing this reversing candlestick pattern. So this is actually what I call a two-bar reversal, and this red bar is actually engulfing the previous one. So it actually shows some bearishness. So for some trader, you can trade using just the candlestick pattern, and subsequently, of course, knowing that this is the rejection zone, there's a fake out spike, you can use it for a trade signal to enter. So the price came down accordingly, and after some time it came back to retest again. So when it retests, this will be the second fake out spike, because what we can understand from here is that the price actually came all the way up to around 0.902. So at this area there might be a lot of those breakout traders. So I mean, trader, you can see it's a breakout or you can see that it's a fake out depending on which camp you are at. So those that are actually buying the breakout will buy, and then after which, once the candle close, it will actually show a pin bar. So some of the traders who actually trade breakout, they don't wait for the candle to close. So what actually happens here is that when they buy it, when the candle is forming, that will form this type of fake out spike where they will see that, oh, maybe they shouldn't even enter. So those are the type of trader who didn't wait for the candle to close and enter. Okay, so subsequently, of course, after the fake out bar, you actually see the price coming down from the rejection zone. All right, so that's so much for the fake breakout. And then I have some other example where you can see for yourself the price divergence, which is the fourth example that I want to share with you. Price divergence with candlestick price action. Okay, so over here what I will be using is the conventional indicator, the most common one, which is the RSI, which stands for Relative Strength Index. Okay, so what we do over here, we can see that the price is actually moving up, higher high, higher low. But what actually happens here is that we have a RSI divergence. So coupled with the use of price and indicator, we can actually so-called like foresee the turning point. So using the turning point, what we can actually do over here is that we can make use of candlesticks like this as a reversing pattern to actually short the market. Alright, so the next example I will have is euro dollar. So euro dollar on the 1 hourly, we do see a resistance zone in this red band. So this is the resistance zone that's identified, and what actually happens here is that we do have a divergence in the price and the indicator. Okay, but then over here what you will see that maybe it's because it hasn't really reached the price target of the market manipulator. So what they want to do is they do a further push. So if let's say you have actually shorted this setup, divergence setup, you might be end up having a loss. Okay, so but then never mind, the market went up a bit more. So what actually happens here is that you have another divergence that's forming at this particular area. So this divergence, after which work out. So what you can do over here is at the next higher high, you can look for reversing candlestick pattern to actually short the market at the resistance zone. Okay, so this is one example of you can use divergence on the resistance zone. Okay, the next example will be the same. So what you have here is the resistance zone that you can make use of it in the future. So over here I've extended to the right hand side where you can see more price action. So after a certain period of time, after a few days, the price actually came back, retests the area. So what you have here is you are seeing some divergence. So you are seeing divergence in the price and the indicator as shown here. What you will be doing after that, you'll be of course looking for either you want to short. If you are an aggressive trader, you want to short using this candlestick pattern, or you might be looking for some reversing pattern, which over here is a head and shoulder to short the market down. Okay, so this is some example that I would like to share with you for the divergence and the using of candlesticks. Okay, so the last one is on weak consolidation breakout. So weak consolidation breakout will be the most successful if you are trading with the trend. So with consolidation breakout, I will have a few examples which you can take a look at. So the first one, of course, is a down move with a consolidation, after which the price goes down again, and then you have a small consolidation. I mean, this is of course compared to the this one is bigger, but it's also a consolidation going nowhere. So upon breaking out at this area, you will see the price going down again. So there's another consolidation on the sideways. So normally trader would like to avoid this because it's going nowhere, and then the profit target is not that significant as compared to if you are in a trending breakout. Okay, after which the same thing again, the price actually came down. So next example I have is on a uptrend. So on an uptrend, what you see is an uptrend that moves in a swift one single direction, and after which you have a consolidation. So consolidation doesn't really just need to be horizontal, flat, or it can be some other form and shape as well. So in this case, it's more of like a wedge that is converging into a single point. So after which there's a breakout over here, what you can do is to also trade the breakout, and then there's a consolidation again, which again form another small breakout after that. Alright, so that's it, people. Here are all the 5 price action strategy that I want to share with you. Hope you all like it, and see you all soon. Bye.